Okay, good afternoon and welcome back everyone to our Options Play Growth Lab series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're going to be talking about a topic that I think is going to be fairly relevant for a lot of traders in the current market condition that we are in, which is how to protect your portfolio for zero cost. We have gold and silver crashing again today. You have Bitcoin near 52-week lows. You have the tech stocks, specifically the software stocks, selling off across the board. There certainly are a lot of cracks starting to show on top of the fact that you have interest rates hovering above 4.2%, hovering around 4.3%. And we're looking at employment number data coming out tomorrow morning that could potentially be a big mover here of the markets. So a lot of concern, to say it lightly, that we see here in the markets overall. Long term, structurally speaking, I would say that things still look fairly constructive. If you look at the earnings that we're seeing here across the board, but short term, there certainly is a lot of volatility and some concern. So I want to talk about a single strategy that can help you protect your portfolio for zero cost in this market condition that we're in. Now, these Thursday Growth Lab series are designed to empower you to trade sustainably and confidently by ensuring that we go through best practices for various strategies, various trading techniques that can help you grow your account sustainably for the long run. Now, before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that I'll be using as example purposes during today's session. My goal is to show you how to protect your positions, your equity positions, and potentially your portfolio as well from a market downturn. And specifically, I want to show you how you do it at zero cost or near zero cost. So, what we're going to go over today is help you understand what a protective collar is, how it works, and how it protects your positions against a downturn. And then we'll talk about the best practices for trade entry and exit rules for this specific strategy. So, when we look at a protective collar, uh, actually, one second here, I'm not sure what happened. Um, Give me one second. I apologize. I was just missing one slide. I'm not sure how it got deleted, but I'm just going to add it back real quick. All right, so apologies. All right. All right, so uh why is this still not showing? There we go. All right. That was an important one. All right, so what we're going to talk about here today, apologize for that delay, is a protective collar strategy. And in the protective collar strategy, it may sound like a complicated strategy, but it's actually quite simple. So I'm going to break it down into its individual components to help you better understand it. So essentially, what we're doing is we're taking an equity position that you own, so a stock or ETF that you own in your portfolio, and what we're going to do is we're going to trade options on top of or overlay option strategies on top of your equity position that's going to help you limit your downside on that specific security. And we're going to achieve this by trading two separate legs. We're going to sell essentially what is a cover call and then use the premium of that cover call to buy a downside put. And the goal here is to try to do that at essentially zero cost so that you get the downside protection without having to pay 2-3% of the stock's value to get that downside protection. So the when you break it down, a collar strategy into its two components, the first one is selling an upside call. So you're essentially selling a cover call against the stock position that you own. And the general rule of thumb that we have with selling that cover call is going to be different than if you were just to if you were generally selling a cover call for income. Because when you're selling a cover call for income, your primary goal is capital appreciation. Uh, you own the stock because you believe the stock's going to rise in value, and the rules for selling cover calls is optimized to maximize the capital appreciation of that specific stock, not the income part. But when you are more concerned about a downturn, upside is potentially less of a concern, meaning you're more concerned about what if the stock were to drop 10%. Think about Microsoft, on earnings, right? The stock dropped 6% the first day, to 5% the second day, and just continue moving lower from there. This is the type of position that you would use if you were concerned about that kind of downturn in your stock, especially with earnings season coming up, and you're concerned that earnings could be a catalyst that drives the stock lower in the short run, but you believe in the stock in the long run. So when you are in that specific scenario, the cover call that you would sell, you would want to adjust. Essentially, what you're doing is you're adjusting to a more aggressive cover call. Normally, we sell about a 10 to 15 delta cover call. Here, we're going to be selling a much more aggressive 30-day, 30 delta cover call. Um, and for those of you that are not familiar, a 30 delta refers to a strike price that has about a 30% chance that the stock will be above that strike price on that expiration date. And when you sell a cover call, you are going to collect income in exchange for essentially capping the upside potential of your stock. Because if you own a stock and you don't sell a cover call, you have unlimited potential. As long as the stock keeps going higher and higher and higher, you'll keep making more and more profit on that particular trade. But once you sell a cover call, you essentially cap the upside potential at the strike price that you've chosen. And this is the 30 delta that we would use for selling that cover call, the upper strike price on that cover call. And what we're going to do is we're going to take the premium that we just collected on selling that cover call, and now we're going to buy a downside put. And by buying a downside put, it essentially does the opposite of what a cover call does, it protects you from substantial downside risk. So if you were to just own the stock, you have substantial downside risk. If the stock keeps going down and down and down, you will lose more and more money until it gets to zero. And what we're trying to do is prevent that specific scenario by buying a put option that allows us to hedge our risk if the stock goes below a certain strike, the put strike. Now, how do you pick your put strikes? What you essentially do is you look at how much premium have you collected from your call option, and you take that and you look at what kind of put option can you buy for roughly the same premium that you've collected on selling that call. And when those two are relatively matched together, you have what we call a zero cost collar. And a zero cost collar essentially gives you this payoff diagram that looks very similar to a vertical spread, because it actually is the same payoff diagram, or the same, synthetically the same as a vertical spread. And what it does is it limits your risk while at the same time limits your upside, but it gives you that downside protection without any cost to you. Unlike if you were just to outright buy a put or a put spread, it might cost you 1, 2, 3% of the stock's value to get 30 days worth of protection. Here, you essentially get similar, if not identical protection, but for zero cost, because you've essentially limited the upside potential in this particular scenario. Does that make sense, everyone? Please type one into the chat window if this strategy starts to make sense for you. And if it doesn't, that's okay. We're going to go through some examples, some real examples to help you better understand. Okay. So the first example I'm going to give you is Amazon. Um, Now, when I put this together, the stock, the stock's down another 3% here today. But, regardless, this is a good example of a stock that you might own in your portfolio. It's reporting earnings this afternoon, and maybe you are concerned about some downside risks similar to what we've seen in Microsoft. So the goal, I'll walk you through this, and then I'll walk you through some more examples here. So we're going to go out to the March 6th expiration, which is roughly 30 days from expiration. Now, you can choose different expirations based on your needs in terms of how much protection you need, but I think 30 days is always a good starting point for most traders, um, especially if you have a catalyst coming up. And even if your time horizon is longer than 30 days, I think starting out at 30 days and then potentially rolling it, or after some time buying more protection at a longer dated option, you can keep doing that over and over again rather than buying a 60 or 90-day collar, even if you might be looking for protection, let's say over the next quarter or so. But in Amazon's example at the time, when the stock was trading at around 233 or so, we were looking at selling that March 6 250 call. And the reason I'm selling that 250 call is because that is the 30 delta at the time of writing this. So when the stock is around 233, selling the 250 call option collected $6.28. Now, 250, when the stock's trading at 233, essentially means that you still have, in this particular case, another $17 in upside for this stock. So if the stock does pop on earnings, so for example, as you can see in this chart here, when it was trading at 232, 250 is all the way up here. It's essentially near the all-time highs. So if it basically gets up back to the all-time highs, you'll still participate in upside. The only thing is that if, let's say, they really blow out earnings and the stock's at 260 or 270, anything beyond 250, you're not going to be able to capture. And then what we do is we take the premium that we've collected, $6.28, and what we do is we go down the options chain on the put side and we look at what strike price is going to be closest to $6.28 in premium. And when I looked at that earlier today, it was around $215 would be the strike price that I could buy for roughly $5.50. So um, just to kind of show you those two prices on the chart here, what we're doing is we're limiting our upside beyond this, and we're at the same time protecting our downside below that support level 215 or so. And as you can see, I'm collecting a net credit of 75 cents, which is virtually zero for a $233 stock. But it is a little bit of income, right? You're collecting 75 cents here on a $233 stock. It's not nothing, but it's a pretty small percentage of your holdings. And but that's the goal, is to be able to afford some level of protection for you. Um, for essentially zero cost, or in this particular case, a small income stream that you're going to collect. And as you can see, that P&L graph here essentially looks identical to a vertical spread. If you were to trade a 215, 250 vertical spread on Amazon, your risk profile would look nearly identical here in terms of what we're seeing here. So you still have, for every 100 shares, roughly $1,700 in upside, and then you're protected from downside beyond $1,800. So even if the stock were to drop 20% on earnings, that's when you'll be able to um, get some downside protection. Now, does that make sense, everyone? Please type two into the chat window if that makes sense to you. Now, I see a comment here saying that option prices are quite different from the slide. You're right. These slides were put together last night. So let's just take a look at where we are today, right? So the stock's down, as you can see, another 8, $9 today. So let's just take a look at structuring this in real time using the current market prices, and I'll show you how to do it. We'll go through a few examples here. So we'll use Amazon just because it's reporting after the close today. Many of you may hold this stock in your portfolio, and maybe you're concerned that the overall tech industry is starting to show some weakness here, especially stocks related to AI, and and you're concerned about some downside, but maybe you've owned the stock at a low cost basis. If you were to sell the stock, you would have a tax bill. Um, and this isn't the case for Amazon, but maybe there are other stocks that you own where you rely on the dividend. So you don't want to sell the stock and lose the dividend. So there are various reasons that you might want to hedge a position and not sell the position if you are concerned about some downside. And this is really where you can use that collar. So here's what I'm going to do. I'm going to go to modify for the stock position here. I'm going to add a call. I'm going to add a put. And what we're going to do is we're going to sell that call option. And we're going to change the expiration to the March 6th one because that's roughly 30 days from expiration. If you want to use if you want to use the March monthly ones, you can. If for those of you that prefer to trade the monthlies, it's about 43 days out to go. But let's just say, for example, with something like Amazon, the weeklies are very liquid, so I wouldn't mind using the weekly options and getting exactly what I want. So what I'm going to do is I'm going to look at selling a strike price for the call option that's closest to 30 deltas. So as you can see in your strike price dropdown, you have your strike price, you have your premium, and you have your deltas. So the closest one, as you can see, to 30 deltas is the 245, which is around $4.95, which is a 29 delta. So let's take a look at that. As you can see, you're collecting just around $5 for that March 245 call. And then what we're going to do is we're going to go down the put strike chain until we find the strike price that's closest to roughly $5 in premium. And that's going to be the 205. That's $4.80. So as you can see, that's how I'm going to be able to put on essentially what is a zero cost collar for Amazon, given the current prices. So the stock's currently trading around 220, call it 225. If I sold the 245 calls, that's giving me another $20 in upside, basically still getting me back up to the top of the range that it's been trading at for the last few months. And then at the same time, it's going to protect me if the stock goes below 205. 205 is all the way down here. It would essentially have to break below this recent range and even further. Um, so we're really trying to protect ourselves from more of a catastrophic, sell-off here in this particular stock by essentially trading this type of strategy, which is essentially zero cost. And, if I take away the security leg for 1 second, this is the actual options trade that you'll be making. You're buying the 205 puts, selling the 245 calls, and you're essentially collecting 28 cents in net credit on this particular trade. Um, and if I add back the stock leg, that's kind of what you're looking at. And just to kind of show you, just if you were to trade a March 6th, 205, 245 call vertical here, these two positions, the one on the left and the one on the right, are virtually identical because of put call parity. You'll be able to do this. Um, you'll be able to do this the same way. So for example, if let's say you don't own the stock and you just want a payoff diagram that's very similar to what we're doing here, you could just trade the call vertical and skip yourself needing to buy 100 shares of the stock and then sell the cover call and buy the put option. Okay? Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. We'll look at a few more examples here. And there is one question that I think is a very good question, which is, do you basically sell one contract and buy one contract for every 100 shares you own? And that is correct. So for example, if let's say you own 300 shares of Amazon, what you would want to do is you would want to sell up to 3 contracts and buy up to 3 contracts of a put. Now, here's the thing. You don't have to, let's say you own 300 shares of the stock. You don't have to hedge the whole position. You could hedge a part of it. So you could say, okay, I own 300 shares, but I only need to hedge 200 shares of that. So you can choose what works for you in terms of a hedge. But if you own 300 shares, you can hedge up to 300 shares, but you can always hedge a smaller amount than that. Great question. So let's look at a few more examples here. NVIDIA is probably one that I think is worth paying attention to right now. Whoops, not the right one. So NVIDIA has been pushing this sort of the trading range, right? It's failed to break out above the upper bound of that range, and it's been hovering kind of near the bottom end of this range around 175 or so. NVIDIA reports earnings here in a couple of weeks. It might be a little bit early to put this on, but maybe we see some contagion across the sector, and we see, a stock like this start to break down here. So let's take a look at um, adding a upside call and a downside put. So when we're selling the call option, again, we're looking, let me change the expiration date to the March 6th one. So for something like NVIDIA that's very liquid, I would use the weekly one. Um, but if you feel more comfortable using the monthly one, you certainly can. So as you can see, what I'm looking for is the 30 delta strike price, which in this particular case is the 190 strike price. 190 has a delta of 30 cents, a 30 delta. That's going to collect, in this case, about $4, call it $4.40 for selling that 190 call. And 190 is all the way up here. Essentially gets us back to the upper bound of the range. And when the stock gets back above the upper bound of the range, I do not participate in any upside beyond 190 if I were to sell that 190 call. And then what I'm going to do is I'm going to go down the options chain until I find the put strike that has roughly the same premium, $4.40, on the put side. So as you can see, that's going to be the 160. And if I do the 160, I'm collecting 440 on the 190s, paying 425 on the 160s. So my net credit on this is essentially 15 cents, which is virtually nothing on a $175 stock. So that's how I'm able to achieve this downside protection for zero cost by selling that upside call and matching the premiums. So when the stock's trading at 175, selling that 190 call gives me $15 in upside, and then buying the 160 calls gives me $15 more in downside. And if it goes beyond that $15, I'm essentially hedged in my position from further downside. Let's go through one more example just to make this crystal clear. Let's look at, let's say, Apple. Apple's trading at pretty rich valuations, historically speaking. So Apple, still at the moment is near the top end of the range. It's holding up pretty well relative to the rest of the market. Um, Now, Apple obviously already reported earnings, so maybe you're not as um, there's not as much of an urgency to put on a collar strategy, but let's say you're concerned about downside given the fact that the stock has rallied back up to previous highs. Maybe you're thinking that this starts to look a bit like a head and shoulders pattern and you're concerned about a pullback here. So let's just take a look at adding that call, adding that puts trade, and then we'll look at that March 6th weekly option. And again, what we're looking for is roughly the 30 deltas, which would be the 285s. And then what we're trying to match is the put side that will give us roughly the same premium, $3.45, which is going to be the 260s. That'll be $3.50. These two are nearly identical. So what that means is that it limits my upside here, to about $10 more upside. And then the 260 puts gives me about $15 in downside. This is the first example that we've looked at out of all the ones that we've looked at where the downside amount is greater than the upside amount, which is more common with these types of strategies because puts tend to be more expensive than calls. And the other ones are more even, in Amazon and Nvidia that we look through the two examples in terms of how much upside you still have versus how much downside protection you get. Those two, in the Amazon and Nvidia example, you were getting much more even exposure on both sides. And that's usually because of earnings. You're getting a lot more premium on the call side than you normally would. Once that earnings goes by, you typically will see collars that skew a little bit more um, against you, if you will, right? Where you have only $10 in upside, like we do with Apple, and but have $15 in downside in this particular example. That's more common, I would say. But heading into earnings, you can sometimes see ones that shift where it works a little bit more in your favor. But that essentially, in a nutshell, is how you would structure a protective zero cost collar. You can make adjustments to it. You can always say, no, I want, $20 in upside. So that's going to bring in $2.13. So what can I afford for $2.13? Maybe the 250s. So you can always make adjustments based on, how much upside you want or how much downside protection you need. But as a rule of thumb, these are your ideal starting points for this type of strategy. Okay. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. Perfect. Okay, so let's talk a little bit about managing a collar strategy. And we're going to go back to the Amazon example here when we talk about managing a collar strategy. So if the stock were to drop, in this particular example, we're looking at that 215, 250 collar strategy on Amazon. If the stock were to drop and reaches your lower strike price, the $215 strike price, this is really where the first thing you have to ask yourself is, once it reaches that lower strike price, um, does your outlook remain bearish? Meaning, are you at a point where maybe you feel that there's now, the stock has dropped, it's reached a prior support level, and now it could bounce from there, right? Obviously, if your views on the underlying stock changes, that's where you would want to reassess and potentially close out your collar. But if, let's say, you still have a bearish view on the stock and the stock reaches that lower strike price, This is really where you would want to look at rolling um, your your collar strategy to the new 30-day expiration date, and then look at recentering the strikes based on the current price of the stock. So the same way we look for the current strikes based on the current price, if the stock were to drop to 215, you would do the same thing. You would want to put on a new protective collar going out 30 days and then getting that 30 delta call option, and then figuring out which put option you can buy for the premium that you've collected on that 30-day option. Um, and this essentially allows you to continue your downside protection as the stock drops. So if your view is correct and the stock starts to drop, you can continue to further um, provide downside protection in your portfolio in this particular case. Now, at any point, if your outlook changes to either neutral or perhaps even bullish in this particular in certain instances, that's when you want to exit your collar position entirely. You don't want to roll it at that particular time. You simply want to exit your collar strategy. And in the second scenario, if Amazon were to trade sideways, if it doesn't really move anywhere, this is really where you would still want to consider rolling it, especially if your outlook remains bearish. So just because it didn't move, or just because it moved sideways, doesn't necessarily mean that you don't believe that there could be still downside here, right? That's really where you would want to use the same, you roll out to a new 30 days to um, expiration date, but then you can essentially keep the same strike prices. Now, you always want to reassess in terms of seeing if those new strike prices still make sense. Are they still zero cost? Sometimes you might have to make some minor adjustments to the strike prices, once 30 days goes by in order to keep it zero cost, but you should be able to do it for zero cost to some degree with the same strikes, if not some minor adjustments to the strike prices. And just like the previous example, if your outlook at any point changes to more neutral or potentially even bullish, that's when you want to exit the collar strategy altogether. So that's really where you want to look at um, just simply exiting your collar strategy. And Edward's asking a really good question. He's saying, wouldn't the put continue to protect you after you reach your strike price? And he is absolutely right. And let's just go back to the previous example. In his example, he's just saying, if it reaches 215 and keeps moving lower, why do you have to roll it? Doesn't the put option just protect you against further downside? And he's absolutely right. Edward, what I'm trying to refer to is that for the stock to reach your lower strike price, it also has to take time, right? So you only have 30 days in your collar strategy. It only protects you below 215 for 30 days. So generally what I'm saying is that it reaches your lower strike price and you're essentially nearing expiration or at expiration. So you get the protection below 215 only for 30 days. If it reaches 215 and the stock hasn't gotten down, let's say the stock is at 215 or lower, and you think that the stock can keep moving lower, that's where you would want to look at utilizing or rolling a collar strategy as the stock moves lower. Okay, so hopefully that's just a clarification. All right, so with that, that covers what I wanted to share with you here today. Hopefully, this gives you a clear understanding as to how you can utilize the OptionsPlay platform to um, to put on a put collar strategy, which I think is quite relevant given the market conditions that we're in. It's really what's the right word? It's not common to see the rotation that we're seeing here in the markets right now. We're seeing this great rotation out of tech into value, into small cap, into international markets, into energy, into industrials. Something that we generally haven't seen in a long time, and certainly not a rotation that's been this durable. We've seen rotations in the past, they sometimes last a few weeks, maybe a month, but this time we're seeing this rotation last multiple months now. Tech has underperformed the S&P 500 by at least 3 months, if not more. Um, and there are, a lot of value has been wiped out in the markets over the just even last couple of weeks. So if you, still have some stocks in your portfolio like Amazon, like Nvidia, like stocks like that, that you are concerned about downside, this is one way you could potentially protect your portfolio, for zero cost. So at this stage, what I'm going to do is I'm going to open this up for our members Q&A session. If you have any questions, you can type. If For those of you that are members, you are attending the session live, you can ask your questions, which is in the Q&A window here at the bottom. Um, so if you can type your questions into the Q&A window, I will answer um, any questions that you might have. And if you're watching this recording, you'll be able to sign up for a free trial at optionsplay.com to use this tool that I'm showing you today to structure this zero cost collar for the stocks or ETFs that you own, as well as if you want to join our next session and join us for our live Q&A session. Okay, so let's look at the questions here. There's one asking me, can I use Shopify as an example? Okay, let's take a look at Shopify real quick. All right, so Shopify, as you can see here, has already dropped quite a bit, right? This is a $175 stock in mid-January. This reports in 6 days. It's already down to 10110. And as you can see, it generated this bullish counter trend trade, which tells me that this stock is so oversold that at the very least, it's more likely to trade sideways and potentially even bounce than to continue moving lower. But it's reporting earnings in less than a week. That could very well be the catalyst that drives it lower. So let's just take a look at selling a collar or putting on a collar for this particular stock. So like I said, we're going for roughly a 30 delta cover call. So that's roughly, let's say, the 130 strike price. And then that's going to collect $4.72. So let's look at what we can buy in terms of protection. So the 100 strike put will cost me about $4.70. So as you can see, that gives me a collar strategy that's relatively zero cost. The stock's at 115. 130 gives me $15 in upside. 110 gives me $15 in downside protection. So that's how you would structure it. Do you use this collar with vertical spread options trades? You wouldn't need to because the vertical spread already gives you the same, it gives you that collar payoff graph, right? So, you don't need to use a collar strategy for a vertical because a vertical you only use the vertical for you only use the collar for a stock position because the stock position, let's see, long stock. Um, You only use it for a long stock position because the long stock position gives you, unlimited risk, right? So if the stock keeps going lower and lower and lower, you keep losing more and more money as the stock goes lower and lower and lower. And the verticals and the collar strategy essentially gives you a payoff diagram similar to the vertical spread, where it limits your losses below a certain point. It is the exact same for ETFs. Yes, there's a replay for today's session. You can find it on our YouTube channel, and since you are already registered for this event, you will immediately get a link after this session finishes with the recording. But you can also find it on our YouTube channel, which will take us a couple of days to get it up on the YouTube channel. But you can either view it publicly on our YouTube channel, or you'll get an email immediately after for those of you that are registered for the live event, with the recording of this session. Someone saying, say in the case of Apple, if I'm concerned about a drop in the stock price, can I do a call credit or put debit instead of a collar as I keep unlimited upside potential, which can compensate for any loss, which is a better approach? Yes, you absolutely can, right? So this is a good question. And the question is, if I don't, if can I sell a credit spread or buy a put debit spread instead of using a collar, because this way I'm going to be able to keep my upside potential. And I think Raju's question um, is a good example of someone who's clearly learned the fundamentals of options trading and is now starting to learn, or is now starting to apply those fundamentals in terms of variations to how to achieve different results based on what you need, right? So, I laid out a strategy here today that gives you that downside risk for no cost, and the trade-off for the no cost part is that you're giving away the upside, right? What Raju is saying is, can I pay a little bit, essentially? Can I take on a little bit of risk by either selling a call credit spread or buying a put debit spread? And it gives me the same downside protection, but it gives me the potential to still participate in upside if the stock rallies significantly. And the short answer to your question is absolutely. Um, the benefit of the zero cost is, I'm sorry, the benefit of the collar strategy is that it's zero cost. The downside is that it limits your upside. So if you want the same downside protection, but you want the upside, the trade-off there is that you have to pay some money for it. So you absolutely can. It's just a matter of whether you want to pay for it or not, and whether you are okay with giving up that upside or not. So it's your choice as to which one you want to do. How do you structure the entire portfolio with the collar strategy? That's a really good question. So let's say you have a tech heavy portfolio. What you would want to do is you would want to use a tech heavy index, whether you use XLK or QQQ. What you want to do is you want to find a very liquid ETF that closely mimics your portfolio. And that really just depends on um, the composition of your portfolio. Let's say you have a broad-based diversified portfolio, maybe you use SPY. If you have a tech-heavy portfolio, maybe you use QQQ. If you have, let's say, all small cap names in your portfolio, maybe use IWM. But the idea is to find an ETF that closely mimics your portfolio as a starting point. You would want to then adjust the number of shares based on how much you have invested in your portfolio. So let's say you have a $200,000 portfolio. That would equate to roughly 332 shares of the Qs. And then what you'd want to do is you want to do the same thing that we did before. We would, structure a 30-day where we sell the 30 delta call. So for the Qs, that would be roughly 624. That would bring in $6.80 in premium. So let's go down the strike price to find roughly $6.80. That would be somewhere between the 570, 565s. So let's say we go with the 570s. And then what you want to do is you want to adjust this for the three contracts, that matches the number of shares that you own in this specific portfolio, or the portfolio that's very similar to this. And that's how you would be able to achieve a similar type risk profile as you do. Now, here's the thing, because you don't actually own the Qs in your portfolio, to sell a naked call, which is what you're doing here, would require a significant amount of margin. You don't have the same risks as a naked call because you actually own the underlying portfolio, but you would need to post the margin to sell that naked call. So that is one additional thing that you do have to consider that you do have to have the margin requirement to hold a naked call. Even though you don't have the same risks as a naked call, you will have to hold the margin as if you have no underlying position because you actually don't own the cues. So that's one way to do it. If you don't want to have the margin, or let's say you don't have the margin, then you could do this across your entire portfolio individually for the stocks that you own. Now, I don't think that if you were to do that, you should do it on every single equity position. I would just do it on your major equity holdings, the holdings that you have a, fairly significant um, exposure in is where I would focus your attention on. I wouldn't, if you were to do it on individual securities, I wouldn't do it one by one on every single one. Would you exercise the put option? You would only exercise the put option if you don't want to, if you no longer want to own your stock. Because once you exercise your put option, you essentially lose your stock that you own. So if you don't want to own the stock anymore, you can exercise your put to essentially sell your stock position. But if you were to exercise your put option, then you have a naked call option. You just have to make sure you close out that call option before you exercise your put. If you don't own Amazon, if you don't own Amazon, then this isn't really an issue because you don't have any downside exposure in Amazon. You could buy a put if you think Amazon's going to go lower, but that's a completely different topic. Um, What Greeks should I look at if I'm looking to buy an equity and a put so that the expected return is effectively a straddle? Buy an equity and a put. Ah, I see what you mean. This was incredible. This was incredible effect for CRM. Recently bought a 260 put and 50 shares. Today the stock's down 3K and the put is up 5K. Um, Jeff, good question. So this comes down to the fact that, when the stock is down, CRM is down quite a bit today. It comes down to two things. One, it's actually Gamma that's actually producing the larger gain on the put side than what you're losing on the stock side. So, your 50 delta, what was originally a 50 delta put is now probably a 60 or 670 delta put. So you're actually earning more per dollar on the put side than you're losing per dollar on the call side. And then at the same time, vol is up so that the put side increases in implied volatility that you don't lose on the call side on the stock side. So I would say Vega and Gamma is really what's contributing to the asymmetrical gain that you're getting on this synthetic straddle. Those are the two Greeks that you would be looking at. How would you use the strategy on an ETF like XLK? You would do it exact same thing as we're doing today on any of the stocks. It doesn't matter what the underlying symbol is. You would do the exact same thing. You would go to add a call on a put. You would look at selling the 30 delta. Whoops. We're going to go out to 30 days. We're going to sell the 30 delta calls, which are going to be roughly the 143 and a halves. That's collecting $1.68. So let's look for the premium put side. That's going to cost us about $1.68. Wow, you're gonna have to go pretty far out of the money, and you're not. And even then, so the weeklies, the lowest strike price is going to be 115. Hmm. Let's go out to the monthlies just to check to see. So the 145s will bring in $2.12. That will be the 125. So yeah, so in this particular case, I think you're better off using the monthlies, right? So selling that 145 call will bring in 226. Buying the 125s will cost you 210. But as you can see, you get a lot. The asymmetry here is not as great. The stock's at 137. That means you have about $8 of upside here. And then your downside, you're looking at about $12 in downside. So $8 in upside, $12 in downside. This is more common in ETFs than in single stock. If one were to tailor the 30 delta guideline for the call, I assume you would predominantly be looking at upside resistance level. You can also use upside resistance level if you want for that to select your call option and then use the premium that you collect there to pay for the put option. Oracle's down a lot. Should I sell or do a cover call on the stocks that I own? So the question is dependent on what's your long-term view on Oracle. So now that the stock is down so much, have you changed your view on the stock long term? If it hasn't changed, then selling cover calls are appropriate. If it has changed, then selling the stock would probably be more appropriate. You'll get a recording as soon as we finish. Since you are registered for this event, you'll get an email immediately after we finish with a link to the recording. And then by this weekend, recording will also be up on YouTube as well that you can watch this on. So with that, that covers what I have time for today and answered your questions. I hope this is helpful in giving you a better understanding of a strategy that you can use in these type of market conditions that we are in today to help potentially protect your portfolio for zero cost. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next time.